Thank you for joining us today at on the webinar, Understanding the Audit Process and Record Keeping Requirements for Small Business. Thank you for taking the time to be here today with us. Just a few housekeeping items to go through. This webinar is being recorded. A recording will be available on our site at www.sanpabloedc.org. Any resources mentioned during the presentation will be available on our site as well. All attendees are muted. If you have any issues with the audio, you may need to click on the webinar screen to enable the audio. We welcome your questions, and please use the question and answer box for those questions. About the San Pablo EDC, the mission of the San Pablo Economic Development Corporation is to develop, diversify, and stabilize the local economy. Some programs and services that we offer and focus on are employment training and support, home ownership, business resources, and access to capital. To learn more about our program and our organization, please visit our website at www.sanpabloedc.org. Now we will have Rena present. She's a representative, Rena Newell from the IRS, and she'll be sharing our screen. She'll be sharing the screen with everyone today.
Well, hello everyone, and thank you all for inviting me to this presentation to share some information with you. Just one sec once I get my screen going. All righty, there we are. Thank you all. Thank you so much for this opportunity. And I think that this is some good information, and I also think it's information that I hear a lot. So I'm going to give you some information in regards to the examination process and fill in also on some record keeping. As Aurora stated, my name is Rena Newell. I'm a stakeholder liaison with the Internal Revenue Service. And as a liaison, we communicate and collaborate with taxpayers in all communities, business, professional, tax pros, et cetera, and we provide outreach and education for the members. We conduct various meetings such as small business forums and multilingual working together sessions. So we really want to hear your voices, and we want to share our messaging with you. We inform partners of IRS policies and procedures, and we also facilitate and promote webinars on the latest tax information. And most importantly, we want to support voluntary compliance by sharing educational information and resources with the small business owners. We want to help avoid expensive, time-consuming errors. So today I'm going to provide some information on understanding the audit process. The IRS audit is a review or an examination of an individual's or an organization's accounts and financial documentation. The review is to ensure information is reported correctly according to the tax laws and to verify the correct amount of taxes reported. So today's presentation is intended to give a basic overview of the life cycle of an examination, and it is not intended to give guidance on specific individual situations. So during the session today, we'll talk about how returns are selected for examination, how you'll be notified of the examination, what documents you need to provide, the purpose of the records, common business expenses, record keeping timeframes, taxpayers' rights, including right to representation, and what happens if you disagree with the examination process, along with some resources that will be beneficial for you to utilize in the future or shortly after you get this information today. So the IRS does use various different methods to select a return for audit. But I want you to also know, just because your return is selected for audit, it doesn't always mean that there's a problem. You should also know that sometimes when folks' returns are audited, they do receive a refund, or there's no actual changes made to the return, and the return will be accepted as filed. So sometimes, though, returns are selected solely on a statistical formula, which means the random selection compares your tax return against norms for returns similar to the one you filed. These norms are often audits of statistically valid random sample of returns as part of the national research program the IRS conduct. So the IRS uses the programs to update return selection information. Then there's also a computer screening process, and the computer program is called the Discriminate Inventory Function System, or the DIF score. And what it basically does, it assigns a numeric score to each individual return and some corporate returns after they have been processed. Now, if your return is selected because of a high diff score, the potential is high that the examination could result in some changes of your income or your tax liability. So if it's a diff score, it's likely that there will be some changes made to that return. Another way is related examinations. If your return is if you have a partner or you're involved with a taxpayer or a business partner or investors whose returns were selected for audit, your return could also be selected for audit. That is a possibility. Now, if this occurs, the next step is for an experienced auditor to review your return, and they may accept it as it was filed, or if there's some questionable items, they may identify the items noted and forward the return for assignment to an examination group. Then there's also the possibility for selection based on third-party information. And this has to basically do with third-party documentation that is forwarded to the Internal Revenue Service, such as forms 1099s or W-2s. Sometimes the information that's received or reported on those information returns, they may not be accurate, or it may not reflect what was reported to the Internal Revenue Service. Sometimes it can be an incorrect W-2 or 1099, or it can also be because when the individual was inputting the information, they punched the wrong numbers and put an amount that was inappropriate. So once IRS matches up those numbers, the document that was forwarded to IRS, if it doesn't match, that is something that would basically be a questionable item, and they want clarification on that. And IRS does occasionally have returns selected based on projects. There's prepare projects sometimes. Sometimes there's preparers who basically prepare returns, and a lot of their taxpayers, or their clients, I should say, would get a lot of refunds. So if a preparer is known for providing a lot of refunds, that would turn into a project. And we look at those returns to see what's going on with those refunds, if they're legit or are there inflated expenses. We also will have tip projects, looking at tip income or refundable credit, if there's an excessive amount of refundable credits that are out there as well. One note that I'll make is amended return. That's basically when you make a correction to your originally filed return. The amended returns also go through a screening process, and the amended return could be selected for audit. So that's just a note for you. But also on that, I want you to know that is because you receive a refund, that doesn't necessarily trigger an audit. So it's all those other things that I just mentioned that come into play for selection for an audit. Now, this next section I'll talk about is how are audit conducted. They're conducted basically in two ways. They're either correspondence audits or they're in-person audits. There's also two types of examinations. There's the office audit examination, and there's the field examination. So any office audit examinations are basically where the individual comes into the office and you bring in your documentation, and the tax auditor or the compliance officer, they'll review the information with you in the IRS office. The field examinations are basically where the individual, most of the times they're revenue agents. They'll either come to your home or to your business, or if you have representation, they will go to your tax accountant office, and then your records are reviewed by the revenue agent. If the audit is by mail or in person, you'll always receive a letter, and I'll go into that a little later, explaining what items are to be reviewed. So just make note of that you'll always know what will be reviewed on your audit examination. One note that I will make though, and I'll get into it a little later, is even though they give you a letter, during that audit, they do have the right to expand the scope if in fact they see warranted. So although there's particular topics that they'd like to address, they can question you about other items that are on your tax return. But going back to this, so basically concluding on this portion here, audits are conducted in person and by mail in the office, at the rep's home, at the taxpayer's home, at the rep's business, or an IRS office. If a taxpayer does have too many books and records to be mailed in for a correspondence audit, that individual could in fact request a face-to-face meeting with the individual who's reviewing their records. Another note that I'll make, which is a very, very important note, anything that you put on your tax return, it is your burden of proof to show the expense was incurred and it actually existed. So we can read this kind of like together. The responsibility to prove entries, deductions, and statement made on your tax return is known as burden of proof. You must be able to prove certain elements of expenses to deduct them. Generally, taxpayers meet their burden of proof by having the information and receipts where needed for their expenses. You should keep adequate records to prove your expenses or have sufficient evidence that will support your own statement. You generally must have documentary evidence such as receipts, council checks, or bills to support your expenses. Additional evidence is required for travel, entertainment, meals, and auto expenses. So this is basically saying that any information that you provide on your tax return, it should have some sort of source document in which that expense derived from, and you're responsible for that. So I hope we made that kind of clear. So when it gets down to the examination, in terms of what you should provide, as I indicated, the IRS will send you a letter, and it lists the items for review and asks that you provide certain documents that will support income and expenses. The supporting documentation will consist of the same documents you used to prepare your tax return you originally submitted to IRS for any tax year. So basically, with that statement in itself, it's basically saying whatever information you use to prepare your return, the source document you use to prepare the return is the information that IRS wants to see, because that same information should have been used when you prepared your tax return. Now, the IRS doesn't care of what type of record keeping system that you use, but make sure that it's one that's suited for your business, and make sure that it clearly shows your income and your expenses. The type of record keeping that you use is based on the type of business that you have and the type of records you need to keep for federal tax purposes. Your record keeping system, it should include a summary of business transactions, and the summary is ordinarily made in your business books, for example, accounting journals or ledgers. Your books must show your gross income as well as deductions for credit. For most small businesses, the business check could be the main source for the entries in the business books. You also should have a copy of your prior returns. Confirm expenses claimed in prior years, which can show that something occurred in your business which attributed to the expense. And sometimes looking back on those things, an expense may be high in one year and low in another year, but we would be able to look at the return and tell and see that, and we can inquire and ask what happened. Well, what happened in this year? This expense was more. Maybe there was a flood or something of that nature, so you had to do something which required you to spend more on it in one year and less in another year. So they do look at those things as well. If an expense was high in one year and less in another year, and we'll ask for an explanation. We won't assume anything. They'll ask for an explanation. So also keep copies or have copies of your prior W-2s and 1099s. It basically confirms wages paid to employees or any payments that were made to contractors and or that you paid or that you also received. Now, gross receipts. During my time as a tax auditor, one of the things that I always notice is everyone could always verify every expense and had documentation, supporting documentation for the expenses. But when it came to the income, they weren't always that diligent on having the supporting documentation for gross receipts. So I think it's very important that any income that you receive in your business, that you should keep supporting documentation to show the amounts and the sources of income that you receive. Some of the things that you can do to ensure that you account for your income that you receive from your businesses: set up a separate business account, reconcile your account regularly. Regularly is basically the time frame that is most appropriate for you. But if you could do it monthly, quarterly, however you feel is fit for you to do it, I definitely encourage you to do that. Retain your deposit information and your receipts, and use a business account only for business transactions whenever possible. You should keep supporting documents that show the amounts and sources of your gross receipts. And if your receipts are examined by IRS, you're more than likely to request a review of the following items, basically, which will account for cash. Your cash register receipts, your bank deposit slips, your bank statements, your receipt book, your invoices, your credit card charge slips, your Form 1099 miscellaneous, and 1099 NECs. Another way to maintain records is to basically electronic records. We more or less accept those just as we would accept hard copies. So during an examination, the auditor needs to follow the similar rules for hard copies as they do for software. So the record keeping requirements still apply even when the records are kept in electronic format. Most records can be accepted by the IRS in an electronic format, depending on IRS's ability to read the software program they're kept on. If electronic record keeping is used, the IRS will request the electronic accounting software backup files. IRS will also request the administrator's username and password, as they are needed to read most data files. A temporary password could be created for the examiner and changed after saving the information to the media, but it must have the administrator's access to backup file provided, because IRS needs to have the same access levels as the administrator. So with all that said, basically, we need the ability to see and view the records as you would. So make sure if that occurs that you have backup information from the auditor. Um, Speak with them, ask them how their records work, go through it with them, go through the process with them, how they maintain everything on their software, so you have an understanding of what you're looking for. They can also back up that information on a CD or a flash drive, but we ask that you not email electronic records to the IRS or the representative for privacy and security issues. So electronic records are definitely more efficient. It's a better way to submit information to the auditor and a better way for us to review versus having the piles of paper. So if you have the ability to do that, I strongly would encourage you to do it. Just get with the person who's going to be reviewing your records and just make sure they have an understanding of your system that you're using. Because sometimes when auditors cannot read the electronic files, due to lack of detail, this usually occurs when the software was recorded in a different program that we may not be familiar with or that we're unable to access. So if there's insufficient information provided electronically, the examiner may request hard copies and confirm the information being reviewed. So we do encourage it. It's very less time for both the individual being audited as well as for the IRS. And we all know that the purpose of our record keeping is not just for substantiation for an examination by the IRS, but it also gives you, the business owner, an overview of how your business is doing. It can basically monitor the progress of your business. It can tell you which items are selling, what needs to be improved, what needs to be changed. And good records can increase the likelihood of good business success. Record keeping is also good for your financial statements, for your profit and loss statements, your balance sheets, and they can help you in dealing with the bank and creditors and help you manage your business. You'll receive money or property from many sources. You can record, your records can identify the source of your receipts, and you need this information separate from your business and non-business receipts and your taxable and non-taxable receipts. So very important for record keeping, not just for IRS, but also, to give you an idea of where your business stands. Not only are we using this information to prepare your tax returns, but as I indicated, it could also monitor your business. Now I'm going to focus a little bit on substantiation. Um, Business expenses are the costs that you incur carrying on a trade or business. And to be deductible as a business expense, the expenditure must be reasonable, ordinary and necessary, and incurred during the course of your business and related to the business. And that's one of the things, if you ever go under audit, one of the things they'll ask you, well, is it ordinary and necessary? Because necessary for the type of business and services you may provide. Let's say as a dry cleaner, you're going to have various uh, deposits for, or a laundromat. If you sell products in the store, in the laundromat, you're going to have various cleaning materials. Even though some of that cleaning material may be industrial, some of it could be for home use as well. So you just want to make sure that the expenses that you're claiming an expense for, they are ordinary and necessary to the business that you are providing. And again, our record keeping will always be the key to substantiating any information or expenses that we incur. The system you use to record business transactions will be more effective if you have good record keeping. So you should keep good documentary evidence that records will support each element of an expense that you incur. When practical, it's encouraged that you make payments by check or credit card, or if you have a specific business credit card that you use, that is always a great idea. Um, if you write checks payable to yourself, sometimes a situation may occur where you have to write a payment to yourself, but it's on behalf of the business. If it's for personal use, document that it's for personal use. But if you use your personal account for business, we try not to commingle, but sometimes we may be in situations where it happens. If you do use your personal for business, make sure you document it, make sure you keep the invoice, the receipt, and when you log it in, just indicate that it was a personal purchase for business, but just have the supporting documentation. They kind of encourage you not to write checks to cash, but if you do, again, your substantiation is the best key. Explaining what that cash payment was for and provide the supporting documentation, because we're always going to look for the backup because we don't know. And again, the burden of proof will be on you to basically tell us what that information was and what was the purpose of it. Was it a ordinary necessary expense that you had to purchase for the business with cash? Now, the objective of any examination related to a sole proprietor is to verify the amount of the expenditures, determine if they qualify as business expenses, and that they were properly treated on the return. One of the things I also make note of, um, the returns are line items, and sometimes all the categories don't necessarily line up to what the expense may be for you. So if you accidentally or incorrectly categorize something, but you have the documentation as well as the information, the proof that it was an expense, that won't be used against you and they won't disallow the expense, because I already know that a lot of the expenses sometimes don't fit on the line items for the items that we want to claim. So we'll have to basically make a note in our ledger, on our receipt, or wherever, just to remind yourselves where you may have put that information. So again, just because you incorrectly categorize it, it does not mean that the expense will be disallowed. So now I'm going to talk a little bit about some certain expenses that I think a lot of people incur and that are probably the most popular. As I indicated, ordinary necessary expense, which in general falls under Internal Revenue Code Section 162. Ordinarily incurred in a particular industry, assuming the expense meets the ordinary criteria. We then look for the necessary component. Is it necessary to incur the expense? If you're a realtor, if you're Uber, if you're all that cars, we know that it's ordinary and necessary. And we encourage you to take these jobs and do these things to make your business successful. But we also just want you to know that you have a requirement to keep records for your car and truck as well. If you use your car exclusively for business, you can deduct your expenses to the extent that it is used for business. If you use your car for both business and personal, you must determine the percentage that is business, and that percentage would be deductible. There's basically two ways to deduct car expenses. Regardless of the method, it's very important that you maintain a contemporaneous auto log. It doesn't have to be detailed. Everyone has a different way of doing it. Some people can put it on their phone for their business miles, but you need something to basically indicate and show what your mileage was. because when we start looking at those percentages, we're going to basically say, well, how did you derive it? How did you come to this? So, and that will be based on the log that you've maintained for that year. So going back to car and truck for the standard mileage rate, there's two different ways that you can take your mileage or claim a car and truck expense, I should say. The first is being a standard mileage rate, and that allows for the application of the standard mileage rate applied against your business miles. The standard mileage rate for 2023, so the tax year we're filing right now, is 65.5 cents. And for 2024, it's 67 cents. So for the standard mileage rate, you can maintain a log of all business related mileage for the year. To use the standard mileage rate for your car, you must choose it in the first year the car is available for use in your business. Then in later years, you can choose to use the standard mileage rate or the actual expenses for your vehicle. For a lease car, you can use the standard mileage rate for the entire lease period if you choose to use the standard mileage rate. Then there's the actual car expenses. When we're talking about actual car expenses, we're talking about let me clarify something because this could be misleading. So when I just spoke about the standard mileage rate for a leased vehicle, if you use the standard mileage rate for a leased vehicle in the first year, you have to use that standard mileage rate for the whole lease period that you have that vehicle. So I want to clarify that. For a lease vehicle, you place it in service for business and you choose standard mileage rate. If you have a 4-year lease, then you're stuck to that standard mileage rate for 4 years. Now, coming to actual expenses, we'll take that same scenario. If you're leased a vehicle and you say, I want to take actual expenses, meaning you're going to take actual expenses, a percentage that's related to business for your gas, oil, tires, insurance, registration, and depreciation. You get the percentage of those expenses that you use the car for business. So again, in order to establish the total amount of business miles, you have to keep a log. So if your total mileage on a car in any particular year was, say, 10,000 miles, well, your total miles was 10,000, your business miles was 5,000. That means you get to deduct 50% of lease payments, gas, oil, tires, repairs, and registration fees. Okay? So then we come to meals and entertainment. And there's been a lot of changes in terms of meals and entertainment, but you're allowed to deduct 50% of the cost of business meals if you or an employee is present and the food or beverages are not considered lavish and extravagant. So when we're talking about dinner or meals and entertainment, basically, you know, we don't want to pay excessively a dinner amount of $900 for you, and let's say you're a person who's a photographer. I'm just using that as an example, but let's be reasonable. Let's be not extravagant, reasonable, ordinary, necessary expenses when we're talking about lavish. For business gifts, you can deduct your business gifts in a trade or business. The business gifts are limited to $25 to each person per year. That means I cannot get 5 gifts from you at different times. I can only get 25 per year. So if you have a long list of clients, make sure they get 1 gift per tax year, no more than $25. So if you use your home, a lot of us use our home, but there's always some misunderstanding about business use of your home. So hopefully I'll clarify it today. If you use part of your home for business, you may be able to deduct expenses for the business use of your home. These expenses may include mortgage interest, insurance, utilities, repairs, and depreciation. To qualify to claim expenses for the business use of your home, you must meet both of the following tests that I'll talk to you about coming up. So a note that I'll make here, business use of your home cannot create a loss nor increase the loss that already exists. That's a very, very important point. So generally, deductions for the home office are based on the percentage of your home devoted to business use. So if you use a whole room or part of a room for conducting your business, you need to figure out the percentage of your home devoted to business activities. So as we see on the slide, the business part of your home must be used exclusively and regularly for your trade or business. The business use of your home must be your principal place of business, a place where you meet or deal with patients or customers in the normal course of your business, and you have no other fixed location to conduct business. It also must be a separate structure not attached to your home, used in connection with your trade or business. Now, there are two exceptions for the exclusive use. Part of your home is used for storage or inventory or product samples, and part of your home is used as a daycare facility. Okay, so those are things that basically, when we're talking about the products or inventory, let's say you sell paintings or artwork or something of that nature, and you have a garage. You basically store all those extra paintings or anything that has to do with the business, you store it in there. That would be an exception to the exclusive use test. Okay. And of course, the daycare facility, if it's in your home, um, very unlikely that kids, you may have allocated areas, but there's not any area that may be untouched by a daycare exclusively used, because kids will be everywhere. So I think that's why they kind of have that as that. So the form that you use is an 8829 to figure the business use percentage. And again, remember that I mentioned on the earlier slide that business use of the home cannot create a loss or increase a loss that already exists. Now, here's another thing that sometimes comes up during an audit as well. There may be situations where IRS may consider your business a hobby versus a business to create income. How much time do you devote to this venture? Are you positioning this business to be your main source of income? So on the next three slides, we'll talk about some of the factors that are considered in determining whether this is a hobby or a business. So for here, a hobby is any activity that a person pursues because they enjoy it and they have no intentions of making a profit. People operate a business with the intention of making a profit. So that kind of just hits it on the head right there. A hobby, you enjoy it. You're not really trying to make any money, but if you're a business, a valid business, then basically you're trying to make a profit with your business. These slides here basically establish some of the things that you should be doing. The taxpayer carries out activity in a business-like manner and maintains complete and accurate books. To me, I think of this as I have office hours. It's not come by when you want to. It's basically, and although you may have people who schedule times to come because you can do that, but you basically have uh, conducted in a business-like manner. You have office hours and things of that nature. The taxpayer puts time and effort into activity to show they intend to make a profit. The taxpayer depends on income from the activity for their livelihood. The taxpayer has personal motives for carrying out the activity. The taxpayer has enough income from other sources to fund the activity. Well, that doesn't necessarily, that could go two ways. Some people may look at it, well, I have enough money, I don't really need to work that hard in it. Whereas some people may have the money to fund it to make it successful. So we would probably explore and pry a little bit more. But this next slide has some other ones as well. Losses are due to circumstances beyond the taxpayer's control or are normal for the startup phase of their type of business. There's a change to methods of operations to improve profitability. Taxpayer and their advisor have the knowledge needed to carry out the activity as a successful business. So basically, someone's not saying, hey, I want to start this business and have no knowledge or skills in what they're attempting to do, because they're pretty much setting themselves up if you don't have any idea what the business is or any skills of the business you're going to open. The taxpayer was successful in making a profit in a similar activities in the past. Activity makes a profit in some years and how much profit it makes, and the taxpayer has enough income to fund it. I think that one was repeated twice. So now we're going to get down to another question that comes up pretty frequently is how long should we maintain records? The length of time that you keep a document depends on the action, the expense, and which the document records. Generally, you keep your records that support an item of income deductions or credit shown on your tax return until the period of limitations for that tax return runs out. Now, the period of limitation is the time frame in which you can amend your tax return to claim a credit, claim, or refund, or the IRS can assess additional tax. The information below reflects the periods of information that apply to income tax returns, unless otherwise stated. The years refer to the period after return was filed. So any returns filed by the due date are treated as filed. Excuse me, repeat that. Returns filed prior to the due date are treated as filed on the due date. So basically, keep records for 3 years from the date you filed your original return, or 2 years from the date you paid the tax, whichever is later. So basically, if you file your return for this year, you pay your taxes. Me personally, I'd say keep it for 3 years. Keep records for 3 years if you owe additional taxes, meaning IRS basically made an adjustment to your tax return. If you pay that tax, go ahead and keep that for 3 years as well. If you have not reported income and you should have reported income, and the income that you did not report was 25% of the gross income shown on your return, then you should basically keep that for 6 years. If you claim a loss for worthless securities or a bad debt, you should keep that for 7 years. And if you have not filed a return, keep your records indefinitely. And if you filed a fraudulent return, you should keep your records indefinitely. So basically, depending on the type of expense it is, if you receive property in a non-taxable exchange, the basis of the property could be changed or it could be increased. So you should keep the records on the old property as well as any new properties until the period of limitation expires for the year in which you dispose of the new property. Lastly, for this time frame, depending on what's going on when you feel that records are no longer needed, if all your taxes have been paid, you don't have a collection issue, um, the statute is no longer running, then it's fair to say that you can go ahead and get rid of those records. For employment records, basically your employment records, you should keep them 4 years after filing the fourth quarter. So there's 4 quarters in a year. If you file your 2023, you should get rid of that in 24, 5, and 6. You should get rid of your fourth quarter, your 2023 941s in 2026. For additional information on that, you can look at publication 225. Well, that's Farmers Tax Guide, or publication 15, or employment tax record keep it on www.irs.gov. Now, one other thing that's also important is taxpayer rights. Anytime you go into an audit, anytime you're presented before the Internal Revenue Service, you always should be informed of your rights. Um, this used to be a short list some years ago, but it's expanded over the last 7 years. And I'll kind of give you a brief of what they're saying. The right to be informed is basically you have a right to know what's going on with your case. So if there's any gaps or any delays in getting a response, you need to consider reaching out to a manager so they can, you know, let you know what's going on. So you have a right to be informed. Right to quality service kind of speaks for itself. Um, you have the right to pay no more than the correct amount of tax. If in fact, because we do make assessments, but sometimes, and this is where your documentation can be important, if something is not correct, you have the right to submit that information to correct it, so you're paying the correct amount of tax. Also, this also helps if you're able to clarify if there's some misunderstanding during an examination. Always ask to speak to a manager so you guys are on one accord and everyone knows that um, this is what you meant, and you have the supporting documentation to show it. So we don't want anyone to pay more tax than they need to. You also have a right to challenge IRS's position. We have a division called the Appeals Division, and I'll talk about that in a little bit. If there's a decision made, you have the right to speak with someone else. They are part of IRS, but they're independent of us, and they have their own criteria that they look at in terms of getting the explanation needed to make a decision. Right to appeal IRS decision. You can also appeal their decision. You have a right to finality. That basically means if something happened and this is the final on it, then we don't want to come back and say, hey, this is not legit. We need to fix that. No, you have a right to finality. When we give you those letters, that basically means, hey, this is it. This is done. Right to privacy. We don't share any information without your knowledge. We do share information with the state of California, but other than that, there's not much else that we will share it with. Right to confidentiality. We won't share, your information is confidential. We have a big thing for making sure information is confidential, not disclosed to anyone without a need. You also have a right to retain representation. Anytime you feel that um, you may need representation to help present your case, you have the right to hire someone to come help represent you and state your position before the Internal Revenue Service. And finally, you have a right to a fair and just system. If at any time any of these items are violated, please reach out to the manager of the individual that you may be dealing with. So with all that said, what happens if you disagree with the examination findings? Well, if you agree, once the auditor makes the adjustments, and you're saying, okay, I agree. I see where I should have had this documentation, but I didn't. So I agree. You sign the agreement and you pay the additional tax you owe. You can either full pay or you can set up an installment agreement. If you disagree, then you can ask the examiner that you'd like to speak with the manager, and hopefully, they'll see your side. But if not, your appeal rights are explained to you, and then the case will be closed. If you cannot reach an agreement with the supervisor, the examiner will write up the case, explain your position and the IRS position, and forward the case for processing. So if you disagree, basically what will happen is within a week after the closing conference with the examiner and the supervisor, you will receive a letter. It's known as a 30-day letter notifying you of your right to appeal the proposed changes. That date is very important. You have 30 days from the date of that letter to either appeal, or you still can agree to the assessment if you want. You'll also receive a copy of the examination report explaining the examiner's proposed changes and an agreement or a waiver form. And if you don't respond to the 30-day letter, the IRS will accept the appeal or the proposed change. I'm sorry, if you don't agree to the letter, basically a 90-day letter will come out. And if the 90-day letter, you'll basically have 90 days to basically petition to tax court. And this letter is basically called a notice of deficiency. And you'll have 90 days to petition to the tax court. And then you'll go through your appeals court and have your documentation and all that stuff. So basically, you have an opportunity to agree, disagree. You'll get the 30-day letter. You may have time to think about it and say, hey, you know, I still stand on what I supported and I disagree, and you can appeal. Or if you don't do anything, you'll receive a 90-day letter. After you receive the 90-day letter, you can petition to tax court. If you don't do that, the tax will be assessed and it will be on the books, and then we'll start to collect. Be looking for ways to collect that monies from you. These are some of the resources. This is like the Bible for IRS. Publication 17, it's a good resource book. Publication 525 talks about taxable and non-taxable. I'm sorry, I'm on the wrong page. Publication 17, your federal income tax. 583, starting your business and record keeping. Travel and entertainment. Pub 15, and especially publication 334. Unfortunately, we don't have these in hard copy. Everything is electronic now, so you can just go to irs.gov and put in these publication numbers to get the information that you need. We also have webinars. You can go on our video portal, and we have various webinars. We have learning sessions, listening sessions for various individuals in business. It's always a good refresher. There's 8 different lessons, understanding your taxes. So I encourage you to go on to the website. And also we have webinars for small businesses, and you can basically look to see what webinars are available. And that kind of concludes the video, the presentation. If you all have any questions, I'll be more than happy to address them.
We don't have any questions in the Q&A, but if you'd like to put in, for the participants, if you'd like to put in any questions in the Q&A, we're ready to answer any of them. Give it a few minutes. Okay, we don't see any questions. Thank you, Rena, for taking the time to give us this very informative presentation. My colleague Marco Sandoval will be putting our contact information to reach out to us if you have any further questions, and we can relay those questions to Rena as well. Our emails are here, aurora.bsanpabloedc.org for me, and for my colleague Marco Sandoval, it's marcos@sanpabloedc.org. Please, actually, I just saw a question come in. What should we look for in terms of authentication of tax letters? Rena, you would like to answer this?
That's a very good question, and I know where that's coming from, being that everything that's going on. When our letters basically are, if you're actually under audit, it's going to come from an individual, right, who may be assigned. And one of the things that I encourage everyone to do is um, reach out to a stakeholder liaison, which is myself, if you have any questions on if something is legit or not. Most of our letters will come from the service center. So for letters that are basically saying you're under examination, that's going to come from the service center. I wish there was truly something that I could say, because technology is so good now, truthfully, that people duplicate our emblems, our symbols, our logo, and things of that nature. But one of the things that you can do is, and this is something I encourage everyone to do, go online and create you an account. If you create you an account, you're going to see the letters that were sent to you, because it'll have your letters, it'll have your bills, any balances that are owed. So that's one of the things that I've been doing to encourage everyone, is to create an account. If you create that account, it's going to tell you what correspondence was sent to you. And then if that fails, if you still have questions, reach out to Aurora, Marco, and I can do some research and see if it's legit, because we do have people who question it sometimes. Because the service center letters, and I'll be honest with you, they do look like someone could create them sometime, because it's a different process that we use. I personally write my letters. The service center has different paragraphs that they plug in for you. So it would look as if someone was basically, creating something like that. I hope I answered your question. And I apologize, you guys. I did not realize my video camera was not on.
Do we have any more other questions for Rena? No? Okay. Well, then thank you again for the participants, and also for Rena for joining us. And thank you again for this valuable information. And if anyone else has other questions, please feel free to reach out to us. Thank you.
Thank you, guys.